Okay, good evening, everybody. This is Eric Mashinsky from the Gold Investment Letter. I'm here with Edgardo Russo and Matthias Bullrich from GIL-Jagercor Energy Corp. Guys, thanks for joining tonight. And so we have some subscribers and investors that are involved with the Gold Investment Letter that I'd love to introduce the GIL-Jagercor story to. Welcome tonight. So why don't we start with Matthias? I know you're going to walk us through the PowerPoint. Why don't we start with just giving us a little bit of background? Matthias, you can go first, and then Edgardo, in terms of your business history.
Sure. First of all, I wanted to thank you guys for being on a Sunday evening. That's very courageous, and so I appreciate that. I will go over our experience and start obviously with mine. I went to Stanford University in California after moving to the United States from Argentina, and after Stanford, where I was an engineer, I moved to Morgan Stanley, where I spent 11 years in high-yield capital markets, doing both U.S. Business, technology, media, telecom, and also international business, where I was the person in charge for our Argentina investments and other Latin America high-yield issues. So it was originally from that experience that I had my first personal business exposure to the oil business down in Argentina. We did at Morgan Stanley the first large independent oil financing for a company that was called back then Paris Companc. After that, it was bought by Petrobras of Brazil. So that was a very significant, over $1 billion transaction, and it was a significant because it allowed the company to overcome the crisis period of 2001 in Argentina and then be sold at a very nice price. So after Morgan Stanley, I started a hedge fund with a person who had been my boss at the firm. And we grew it from about 20 million originally to about $1.5 billion, and I wanted to continue growing. So I went after that to work with Steve Cohen of SAC Capital. He's been in the papers recently, so hopefully his bigger troubles are over, but he's a very successful investor. Steve, with the subprime crisis and the debt crisis, decided to move away from fixed income markets, so I've been investing on my own since then. And it was last year in 2013 that I got involved to finance a very large acquisition in the oil business in Argentina. And so it was through that work where I was targeted to find $1.5 billion in financing. My client was going to contribute $1 billion for a very large acquisition, that I started getting back into the opportunity for oil in Argentina. And so that's what eventually brought me together with Edgardo, and we decided that this was a very significant opportunity, but most importantly, in addition to that, is we had the right timing. The catalysts were right. We're going to talk about that after he's done. And so this is how we put this company together that hopefully you'll help us finance. So with that, I'll let Edgardo talk about himself a little bit, and I'll keep going after that. Thanks.
Thanks, Matthias. Edgardo.
Yes. Thank you all you guys for hearing us today. Kind of background: I was working for YPF, the largest integrated oil company in Argentina, for 17 years. I was working in the reservoir and production engineering side until I became a manager to leading different groups or teams to operate and in the exploitation side of the fields, different fields, black oil, gas and condensate fields. The last field I was leading was Loma de la Lata field, that it was the biggest gas field in South America. That is the biggest producer of gas for the consumption in Argentina. After that, I was start over a company the startup of the drilling company that is a subsidiary of YPF, was the first time here that a operator company, an integrated company, bought and operate drilling rigs. In YPF, we bought 15 drilling rigs, and I have to put all the crews together to operate these rigs in Argentina. That was very, very uh, challenging because the unions here, but we made a very, very good thing there. And after that, after the 17 years, I moved to Baker Hughes because these guys offered me the opportunity to open a field development business in order to compete with Schlumberger, because Schlumberger have a production management unit since or for the last 15 years, and is made a very huge revenues against the normal revenues of a service company. And that's the reason because Baker Hughes put together a team in order to open a field development business in 2013. We bid and win a couple of fields in Kuala Lumpur, working for doing production management and field development for Petronas, and a couple of fields in Mexico working for Pemex. But after a couple of months putting all together companies to operate that fields, Baker Hughes believed that it's not his main course of business, and that's the reason they try to sell this department, and that's the reason I decided to leave Baker Hughes. And that time I was talking with Matias about the opportunity to put all the things together and all the things needs to create a production management company or field development company. Is different. It's the same explanation for the company. Some guys call field development, some guys call production management business, and it's a very, in Argentina you have two good things. That is, there is no the competition for that kind of business. There is only one company here doing production management, and in the other way, the opportunities in Argentina look brighter than the previous years, because we have a very huge opportunity in front of us in the oil business. That's the reason I joined with Matias in Jagercor in order to put together a field development company in my country, my home country. That's a place I really know, and it's very, the opportunity that we have in front is a very, very good opportunity.
Thank you, Edgardo. So, Matias, along those lines, before we get into the presentation, from a standpoint of most of my subscribers, even though they're global in nature, predominantly they exist in the United States and Canada. So, from our position, not being super familiar with Argentina, the press lately has been terrible. We've read a little bit about, it seems like a bit of an unconventional default, but default in the headlines nonetheless. We see some of the inflation going on in the country. So, it's one of those times when, frankly, from my position, from a contrarian standpoint, these are when I like to look at these type of plays, from a geographic standpoint, geopolitical standpoint at least. But you guys are, this is your homeland. So Edgardo gave us a small glimpse, but Matias, what are your thoughts about the, just the environment in Argentina to do business going forward and currently?
Sure. First, I just want to give you a little bit of background so that you can think through with me and reach, hopefully, the conclusion that indeed this is the time to go in. Argentina had a cyclical past in its economy and in its political management. It basically has been a democracy on and off, but only since 1983. has it been a democracy? So let's start with that. So it's been a place that had the usual Cold War driven coup d'états, and since 1983, it's a place where the president wins by elections. However, the place Argentina had a super boom in the early 90s. As the Cold War, came to an end, there was a lot of money floating around finding homes, and so the country embarked on a very significant privatization program where enormous amounts of capital flowed in. The stock market was up over 1,000% in a period of less than 3 years. And so companies that were state-owned, very inefficient, bloated with personnel, were sold and improved in any measurement of performance that you could think of. One of the issues, however, was that the government never quite got to rein in some of the costs of operating businesses there. Sometimes labor is expensive, and so as the country tied the local currency to the dollar, you had a situation where it could not print money at all, and at one point it couldn't borrow money anymore. And so Argentina had a very brutal, if you will, default in 2001. The reason it was more brutal than what you could call a normal default was that the banks had been compelled by the force of law to buy the government debt. And so when the government debt stopped paying, the banks were insolvent, and so there was a solution that was fairly drastic on the population. So why do I give you this background? Because out of those ashes, rose a new government led by the Kirchner family. You can say first it was Nestor Kirchner, subsequently his wife got elected. But the most important thing of this is that they had the luck, or maybe Argentina the bad luck, that this populist government coincided with an enormous boom in commodities, which are Argentina's main exports, so especially soybeans. So the country's had the wind at its back since 2003, 2004, when soybeans started going higher in price. And we've got now to a point where in 2005 and 2010, the country restructured 92% of its foreign debt. And so people came to the conclusion that finally the offer the government gave them was better than any alternative, and 92% accepted that. And so Argentina has been paying its debt until a couple of months ago. I'll explain that in a second. But in general, because the 92% is not 100%, this is an important point that I'm going to make. Argentina has a very, very unlevered position worldwide in terms of its foreign currency debt. It has about 14% of its debt to GDP is foreign owned, so it's one of the least levered places from that point of view, and that will be one of the solutions to the issues that we present now. So when you have obviously a populist government that continues to live above its means, that the end obviously always arrives when you just have no capability to borrow. Eventually you hit significant inflation, and so what's happening now is everybody's turned very angry against the president, and two things that are very relevant for us are, first, the policies instituted in the early 2000s were such that producers of energy, both oil and gas, were very severely underpaid. And so what everybody does when you don't get paid what your labor's worth, they stop producing, they stop exploring. And so production in Argentina dropped dramatically while consumption was rising with the economy. And it got to a point in 2012 when, for the first time in 60 years, Argentina went from being an exporter of energy to a very significant importer of energy, to the tune this year of about $14 billion of energy imports between oil and gas. Gas mainly from Bolivia and the LNG ships from Qatar, and oil from different places. So here's a situation that forced the government's hand, because it started asking, the energy business obviously started consuming foreign reserves, and so the result of that was the government had to do a 180-degree turn to its policy, and it concluded to reverse the decline in payments to producers, and it went from 45. These are significant numbers, from $45 a barrel before the policy changed to now 83. So almost a double in dollars in what you get paid for production. 83 bucks a barrel is a very nice number, and everybody can live with that. In gas, it went from $2 per million BTU to a program now where new gas comes out at $7 per million BTU, which is still low, but anyway, nevertheless. So that's one of the basic things that we're looking at, a change in policy that came not even in a new government, it came in the old government, forced by the realities of the marketplace. And the second very significant thing for us is this. There was a fear, at least I had the fear, before August of last year, that there could be still some sort of political maneuvering to try to keep this troop in power. However, in August of 2013, there was a legislative election, and the government lost huge. They went from having won the presidential election with 54% to only getting 20% of that vote. And if you look at any chart of Argentine stocks, you will see them breaking out on volume, huge, in August of last year, and the stock market in dollars is up since then over 100%. So that means that it's not just me. A lot of people that are looking at this understand that this government is over, and so despite the fact that the news is very bad, people look at the future, and the future is much brighter than the present, and hopefully than the past. Why is that? And the reason is, A, that for once a populist government lost huge. That means the perception of their policies is now unpopular. And the second thing is that there's only one of three people that can be president, according to any polls. There are three leaders. Their names are Macri, Massa, and Scioli, but this doesn't matter. What really matters is none of the three is a leftist type populist politician. Two of them are clearly center right, if not right, and the other guy is a center right that plays a little bit to the president because he needs help with his provincial budget. So when you put this thing together, what you do know for a fact is, one, the government's changing, and two, it's changing for the better. I'm not saying that we're going to get a statesman, but I'm saying that compared to this person in power today, things are going to be a lot better, because there's just, you look at what these guys' policies are, their teams, what they think, what they write, what comes out in the newspapers, and any of them would be a breath of fresh air compared to current policies. So there are going to be elections next year, and what's going to happen is one of these three guys is going to get elected, and the next thing that's going to happen is, remember something, the country has no leverage. There's very little foreign debt. So what you're going to do is you're going to go out to markets, make peace with markets, be nice, issue debt in dollars, stabilize the local currency, and if past this prologue, what you're going to have is a very significant rally in financial assets in Argentina, because you're going to have debt that trades at tighter spreads, a much nicer speech to investors worldwide, and a country that begins to look like a normal place to do business. So whatever you may be reading, I think that any serious financial analyst is going to give you a version of this as why Argentina now is the time and not after the election, because people pile on in anticipation of the news. And the one strange and interesting thing here is, the news. The news is President Kirchner will no longer be president. So that's really the aspect of what I call the policy and the politics of the deal. And so I have a third P, which matters. So this is a deal, if you want to remember a tidbit, is you call the deal of the three Ps, because the first one is the policy change, the second one is the politics change, the change of government, And the third one is the P for petroleum. And why do I say that? I say that because Argentina has been producing oil for more than 100 years, but it has always been a marginal oil producer. It has produced for its own consumption and had a little bit left over to export, maybe refined products to Europe and you know, the export of gas to Chile, but it's never been a major producer of hydrocarbons to have an access to export. However, a few years ago, Edgardo was drilling in a place called Vaca Muerta, and he struck a giant field, and it's called Vaca Muerta for lack of a better name. It's a horrible name. It means dead cow, but more interesting than that, it has the fourth largest reserves of oil, shale oil in the world, and the third largest reserves of recovery shale gas. So this transforms the energy map of Argentina, and it's created a frenzy of anticipation in terms of large multinationals. We're talking Chevron, Shell, Total, Petronas, everyone making their stake, claiming their stake without yet investing major dollars. Chevron's in for only $1.5 billion, Petronas for $500 million. So there are numbers that are, call it, you know, less than the 10 billion type money that moves into Russia, but still the numbers add up, and it's only in anticipation of, in my opinion, this woman leaving the presidency. So that means a lot of oil money is moving into Argentina, and it also means that a trend that is present will accelerate and become more important. That trend is the trend to put all of your resources in your giant fields. So you go into Vaca Muerta, you spend $3-4 billion. You don't put your best people in your $100 million field or your $50 million field. And that is really what creates the opportunity for us. There's 6 major producers, soon to be, you know, a few more with these investments, and they put their people and their money into their best fields, and they leave for us what they call their marginal fields, which is our foam, if you will. Our bread and butter is to go after these marginal fields and operate them better than the large companies that are dedicated to their major assets. But I'm going to ask Eric, because I am switching gears here, and he wanted me to first talk about Argentina. If you have, Eric, any comments that you would like me to address specifically about Argentina itself, then I will, that I didn't address in the last few minutes.
No, thank you. Very, very thorough. Before we go into it, I would say from here, let's drill down on that specific opportunity that Jagercor is going after, which you organically started to move to. But just as an aside, I mean, the fact is that there are, even with the bad press, there's some huge smart money that is putting some money where their mouth is in terms of looking at a better future in Argentina. For example, via YPF, we're seeing the likes of George Soros, Third Point Capital, some of the very, very significant and smart hedge funds that have been increasing their stakes. Kyle Bass, who I believe is one of the top couple dozen hedge fund managers in the world, believes Argentina is the biggest opportunity in the world. A lot of our subscribers are familiar with Doug Casey, who's a very astute investor and newsletter writer. I had the pleasure of hearing him speak to a very small crowd in Aspen in August, and he as well echoed that he believes the best geographic play in terms of investing in the world is Argentina. And from all of that, I think personally, even though I do a lot in gold and precious metals and even technology, which I don't write about in the Gold Investment Letter, looking at a new country and having some exposure to it from a geopolitical standpoint, Argentina to me is a no-brainer in terms of the risk reward. So then it comes down to, what do you have exposure to? And I think naturally, the first thing you look at is real estate. And secondly, due to what you talked about with the seemingly massive resources of oil and gas in Argentina, yet the fact that there are, what was last year, $14 billion, U.S. equivalent of imported oil and gas. I mean, that anybody who has a brain who comes into office is going to, and I see some of the incentives that are coming down the pike as it is. To develop those resources, within the country. I think that energy is the second area alongside of real estate that I want exposure to, which is why I've paid attention to what you guys are doing with Jagercor. So, Matthias, feel free, and keep in mind, as far as the PowerPoint as a guide, feel free to address what you like and skip over whatever you like. But tell us a little bit dive into the what you were talking about, which is the business plan of Jagercor and your relationship with Central. And I'll let it right back to you.
Sure, I'm going to try to make sure I am short and to the point, because you don't want this to be dragging on too long before we really dig into our business. So, as I said before, we want to be very efficient with our capital. So our plan is to go to companies that are already producing oil. We don't intend to explore at this point in time at all, and look at their existing and producing oil fields and make deals with those companies to give us an opportunity to participate and improve their operation in those fields that they don't consider strategic to their operation. That's the general concept. Now, why do we want to do that? Well, the reason is to participate in Vaca Muerta and in the large opportunities. Those are very capital intensive. We think, for example, that you need at least $500 million to have scale in Vaca Muerta. So we're going to let the majors do that while we go to the existing fields and say, okay, well, what do you need? How can we help in this small piece of your company where you're not really doing your best? And for us, that small piece of their company is a huge percentage of the business that we can build. So the first deal that we have, and we got a memo signed in April and a final deal signed the first week of August, is a deal with a company called Central Resources. Central is a Denver-based company. They produce also in Canada, in Calgary, in Colombia, Brazil, and Argentina, and Edgardo negotiated with them a deal whereby they let us drill 3 wells in their property in Catriel Oeste, which is in the province of Rio Negro. This is a very mature field. 500 wells have been drilled there. 120 of those are still producing. So I want to just make sure you guys, I'll say this 50 times if I need you, we are not an exploration company. We're not drilling in places that can come up dry and we come home and saying, well, we didn't find any oil. So we have selected the 3 drilling sites, and we've already started drilling the first well. We get 70% of the money from all the oil sales until we recover our investment, and we think it takes 9 to 11 months for recovery. After that, we get 40% of the oil. And we have no lifting cost until we recover the money, and after that, only $7.50. So these are extremely good terms, and it allows us to, if the concession lasts with an extension that comes in 2016 for 12 years, and the total production that we expect from that, given the averages of the existing wells, is something around 11 million bucks, and we get 11 million bucks by investing 4. And so these are extraordinary transactions. We're very profitable transactions, and our core is first get your money back and then sort of keep milking that cow for as long as you can. The concession that will be extended at the end of 2016, another point to emphasize Eric's point, is the law again changed in favor of producers 2 weeks ago, because in order to extend the concessions, the fees have now been reduced to approximately 50% from our reading of the law of what they were before that. So if before we needed to put in $2.5 million to extend at the end of 16. Now we think it's only $1.25 million that we need to invest in order to extend that concession for an additional 10 years. So your basic deal is, okay, we're drilling 3 wells. We get 70% of the money back from the production of the oil. And after that, after we've gotten our investment back, we get 40% of the oil, of the money from the sale of the oil produced. We also have the option, not the obligation, but the option to drill an additional 5 wells with the same exact economics, i.e. we drill 5, we get 70% of the money first, then 40, and we can extend together with Central when Central extend their concession. So if we put those 2 deals together, we have a total possibility of almost 1 million barrels, about 900,000 barrels of oil from this tiny startup that we are sort of putting on turbo.
So Matthias, along those lines, let me just pause real quick. So yeah, you're starting to get to the slides. What I would encourage you to do is
Yes.
Maybe just slowly go through these visuals. Those are important as you're mentioning these. But while you're doing that, maybe just go slowly up to slide number 7. Go back to slide somewhere around the 6 and 7, if you could back it up. Yeah. And that'll give, there you go. So Edgardo, that'll give you a good segue. So Edgardo, why don't you tell us about a couple of things? One is, so why Central? Why this particular field? And what do you see as the risk reward in terms of the drilling of the first three prospects?
Okay, great. First of all, remember that Jagercor doesn't have operation in Argentina. We are a brand new company, and I use kind of my contact list in order to present Jagercor. And as Matthias say, our core business is to operate fields in name of others. For example, YPF, that is very interesting Vaca Muerta, and it's living his small fields. And when we are saying small, we are talking about 1,000 barrels per day. Is not so important for them. But in the other side, as to reinforce Matthias' comment, in order to drill a well in Vaca Muerta, the recovery of oil is similar to a conventional oil till today, but the money is 24 million per well in shale to drill in Vaca Muerta. Because Vaca Muerta is a very brand new field, the first well was drilled in 2009, sorry, and they are improving this shale. In the opposite side, we have fields like Catriel Oeste, that is a very known field. As Matthias said, they are drilling their work first YPF, after Chevron, and right now Central Resources. They are drilled. They were drilled 500 wells since 1964. At that time, the idea to collaborate with them in order to improve his economics, it's in order to have our first gig, as I say, to start to have a track record for Jagercor in Argentina, because we are talking with Sinopec, we are talking with YPF, with Petrobras, that's the first 3 companies in the country, but they are thinking if we are for real or not. That's the reason we are going for a smaller company. That kind of Central Resources have 4 concessions here in Argentina. Imagine the whole concession in Argentina is around 350. 120 it's in hands of YPF, for example. And as I say, Central have 4 concessions, and they are producing around 1,500 barrels per day from the 4. And from Catriel Oeste only, they are producing around 1 1,000 barrels per day. They are using the revenues of his production to improve his secondary recovery as a secondary recovery project that is very important, that is collaboration with his production, and we offer them to put some money in drilling new wells. Why we think in drilling new wells instead of workover? In that kind of reservoirs, a lot of information that you have is in order to provide that. For example, Matthias, could you move for the map, please?
Yes, I will move back to the map.
Okay, thank you so much. The green bubbles are cumulative production for the wells, and the brown and yellow color in the map is relative to the thickness of the reservoir. There is a very known reservoir there that is Quintuco Horizon. That is, this field is located between YPF fields, Chevron fields, and Petrobras fields. That everybody they are drilling in Quintuco because it's kind of a sure place to drill. And when we analyze to make a workover or a new well, the price could be with a workover around 50 barrels per day at the initial production, 50-60 barrels per day, and with a new well, selecting the place in order to not interfere with actual wells is more than 100 barrels. When I take a look of this map or the history of Catriel Oeste, for the last 200 wells that they drilled, 90% of them produce more than 100 barrels per day. Only 3 wells, it's like close 1% of the possibility to go dry. And the average production of the last 200 wells drilled there is 150 barrels per day. We are not gonna explore or discover a new field or new reservoir. We are going for a very known reservoir with a lot of information that is, for us, for the group of geologists and reservoir engineers that we are working for us, for Jagercor, the certainty of find oil and an interesting amount of oil is better than a workover. That's the numbers that I'm commenting for you, Eric. That is a lot of information in seismic. It's a lot of information from the logs for 500 wells, and it's the possibility, because we are in the whole engineering process, we talk about possibilities, but the probability to not find oil is less than 1%, and the probability to reach more than 100 barrels per day is 90%. And as I say, the average production that we could find there is 150. Is as say in the oil business we say is a sure shot. Is better than a workover. That's the reason that we talk with Central Resources in order. We know that they are using his money to a different kind of project, and we could that give us the opportunity to drill wells, to have production, to manage production, and to reach production before 2014 ends. I don't know. I am a technical guy. When I start talking about this, and maybe I talk a lot. If you go for more precise information, please ask.
You got it, Edgardo. No, that was very, very helpful. So, Matthias, why don't you walk through the economics of the project, starting on slide 9, and we'll just go from there.
Sure. So what we have here is we first have to make an investment. The investment is about $3.2 million. And it shows in at the official exchange rate 4.2, but in cash we really need around 3.2. And as Edgardo said, and this is very important, I don't know if you heard, but he said we're going to be producing oil before the year end. We are in October almost, and so we are making our investment. We already made about half the investment, and so we're making the remaining half in the next few weeks. And soon after that, we are producing oil, and our first payment comes very quickly. We'll have a 40-day turnaround with Central in our contract. And so in the beginning, the well produces, call it 150 barrels, and when you do go through the math, our netback is about $440,000 per month. So that drops off a little bit every month in our projection as we are using a normal well depletion. And after recovery in 9 months, then we go to 40%. And so when you do the return on capital of the project, we are talking something in excess here, in excess of 60%. In this case that I'm showing right now, we have, for example, a 74% return, and you can do sensitivities, but every case that we're using, let me see if we have another case. Here's, for example, cash flow 3 with a production through 2026. Even then, we have an over 60% IRR in the return of the money plus the profit. So these are really good, obviously, capital returns, and I think they're going to position us to find larger transactions and even more efficient transactions from the point of view of the capital deployed. So we hope to be telling you guys, first of all, in very few weeks after we finish this round. We hope the next press release after the round is done is okay, and here's our oil production for the month. Obviously, we'll have to be careful with how we present that information because Canadian rules require all sorts of things, which we'll obviously comply with. But we will be producing oil before the end of the year. So those are the basic economics. We got an over 60% return on capital in this deal without any use of the additional option for the 5 wells. And Edgardo's working on transactions that are multiples of this in terms of size, and for investments that are not much larger than this. So our goal is we establish ourselves, we've proven ourselves. We've got a core investor group that hopefully will be very satisfied with the result of this financing, and we'll grow from there. And we want to make a significant independent oil company based in Argentina. And I've been in the capital markets for a very long time now, and so I understand that it's not just a matter of investing capital. You've got to be careful with the capital you're investing. Make it as small as possible, and then make sure you get a nice return back. So that's really our core plan. This is our start, and then we hope to grow by leaps and bounds, but being very careful as to how we deploy our money.
So, Matthias, that's very helpful. I think what we could do next, as you go to the final slides, we'll be talking a little bit about the ability for the company to expand to 8 wells and what that would look like in terms of additional capital requirements. Let me just say that, so we're not going to get into the details of the private placement. There was a private placement announced by the company recently. last week. Just to give a little background on the cap table and the cap structure and financing plans of the company. You guys, and correct me if I'm wrong, Matthias, you raised approximately $2.6 million Canadian earlier in the year, and with your final obligations with Central, it looks like on this current raise you're looking for approximately another 1.5 million US to 2 million, somewhere in that ballpark, that will get the company's obligations for the first 3 wells completed, give you ample cash flow for your burn, which is very nominal from what I recall. Maybe you could give a little bit of color on that before you get into the other economics in terms of what your cash position will be if, for example, you do raise and close on this current round, 1.5 to 1.8 million US. Just walk through your obligations. This again, because we may not have accredited investors that are listening to this recording, we're not going to talk about the offering specifics. But just in general strokes, is that correct in terms of what you're looking to raise? And then how is that going to look as you go into Q1 with the option to expand into another 5 wells?
Sure. We obviously will make these next 2 payments to Central in the next month. And with that, we should complete our obligations to them. We have a couple of months where we need to pay Edgardo, or we need to pay lawyers and things like that. So we have some burn that oscillates, but it's around $50,000 a month. And this, there's a lot of fees that you have to pay for just being public, auditors' fees, things like that, where it's difficult to not obviously pay those. Those are regulatory things. And then we have some salaries down in Argentina. So we do have that level of administrative expense. So once we do that, by the month of January, we start recovering our investment. So our cash starts going up again, hopefully relatively quickly. And the 5-well option, if we use it, I'm thinking at this point that we would do some of it internally, and some of it we may be able to farm it out, and we can manage that for a fee, possibly, so that we are, again, efficient with our capital, and that fee would come, if we decide to use that option, just entirely as profit to us. Maybe we need to hire 1 or 2 people to control production at the wells down in Rio Negro. But the relative increase in expense would be de minimis compared to being able to operate those 5 additional wells. So that could, for us, could be a boom. I have to be smart, and we have to be smart as a company as to how we finance that. But so that's an option. We'll have to consider different avenues. We could offer this as the 5 wells as a preferred return for people that are interested down in Argentina and investing in production. So we have many options. The key for us today is to finish up this effort. After that, I think we will be launching, from a safer position into larger transactions, and hopefully with some success in the stock market.
Right. So. Yeah, just in terms of my commentary here while we get close to wrapping this up, I find it interesting that, currently with the private placement being announced at 6 cents, your stock is trading around 7 cents, 6.5 cents in the open market. Pre-closing this financing, the company's market cap is less than $5 million. And so with the cash that is either on hand and or has gone directly to Central for the commitment on the first 3 wells, the market is really valuing the prospects in terms of the possible impact of production literally within weeks to a couple of months. It's a very, very small valuation on that, and I love it because it basically says that if you have some production, even if it was on the lower end of what the thought is in terms of these 3 wells, if it was even on the 100 barrel a day average side, these numbers seem very realistic. And if you're getting to a point where you're cash flowing, even if it was $250,000 a month, with this type of a market cap. And keep in mind, folks, that if we see about a $1.5 million U.S. raise here with this offering, we'll be closer to 100 million shares outstanding. Pre-financing it somewhere in the mid-60s, but we're still going to be under 100 million shares outstanding, I believe, on a fully diluted basis, or very, very close. So, we've got the ability to see cash flow within, 90, 120 days to the company with 3 producing wells with the option to do 5 more. I like the situation as it pertains to a speculative play. I would call it speculative mostly just because of the fact that the company is new and it is, we haven't seen the production yet. If we get on the other side of the production being a reality, I would see a reset in the market in terms of the valuation. And that could easily be, back to a point where the stock is in the 15, 25, 30 cent range. I could envision that by the end of the year if we see the production numbers work out. But maybe both of you guys could just, in summary, why don't we start with Edgardo? In terms of the longer-term vision of the company, it's nice that we see details in terms of what's on the table today, what's already been committed to. There's action being taken. There's drilling that's already started. But in terms of the longer-term vision of the company, assuming that you're able to execute and work on this small transaction and show that you guys can do it, longer term, Edgardo first and then Matias, what type of transactions do you see that could be potentially out there for a Jagercor, especially if some of these larger companies see that you are in fact real and you're able to step in, whether it was with workovers and some of the smaller fields, and or just some of the transactions that you see that could be out there for a company like Jagercor that's willing to take something on that's a little bit bigger after this transaction, and then also just the long-term vision and upside of the company. So Edgardo first, and then we'll go to Matias.
Okay, excellent, Eric. As I say, our core business is to become a field development service company. As my vision is to be the first one, because till today, as I say, only one company is making production management company here for YPF in only one field. It's a local company. Schlumberger is not here in competition because it's more connected with drilling wells and that kind of operation. And the conversation that we are having till today with different companies, YPF, the companies that I mentioned before, is to have the possibility to operate the field, to give us the key of the field in order to operate for them, to manage the production, the operation of a common word is the exploitation of the field, in order to keep the wells that are in effective production today, improve the production with putting some focus in the production engineer side. Remember that we are telling that, for example, YPF, they have 120 concessions, but they are putting all his effort. They have like 5,000 employees, but in the oil technical and engineering staff, but they are putting all the focus, all the effort in Vaca Muerta, in the south, in the Diadema reservoir, and there is a couple of like 3 or 4 conventional fields that they are exploiting. They are operating with a very, very important focus, and there is like 50 or 60 concessions that are producing as they could, no focus, no engineering, and we are offering them to take over the field. They are owning they are keeping the concession in his hands, in its hands. YPF is gonna have and manage the reserves, but we are making improvements in the actual wells, and as an upside, we are gonna offer them to make workovers or to make new wells. In that kind of contracts, the owner of the field pays for the investment, and after that share the new production with the contractor. In that way, we are receiving some fixed payment for operate the field and some variable payments connected to the new oil that we are extracting for the field. And as I working for such a long time in YPF, I know pretty well, and everybody knows that a lot of oil beneath the wellbore that could be extracted if you put some focus, some engineer, some technical stuff there. And that's our core business, to improve in a small field, small for the relativity, because 1,000 barrels per day field for us is a huge field, and we could improve maybe 30% of the production. For YPF, they are looking for 15,000 barrels per day, and 1,000 barrels is not important. But with the energy needs that we have here, every extra barrels that we could find is going to be very well paid. That's another thing that I forgot to mention, that is all the activities are in the oil business are dollarized. Is you sold your services in dollars, you sold your oil in dollars, and you receive dollars in payment for activities or production. That's a good thing here in Argentina, because you are keeping really away from the inflation. That's the core business, the long-term business that we are looking for, and the opportunity is here because it's not a lot of companies trying to do it right now. Maybe in a couple of years, when the government change, there are more companies to compete with us. But if we have the position created and we are for real, as I say, we're going to have the first, how do you say, the first
mover advantage
to ask.
Great, and thank you, Edgardo. And Matias, any closing comments, and also about your long-term vision for the company?
Sure. The way I look at this is, first, we want to be for other people with fields and the will to operate in Argentina. We want to be a solution. We want to be the people that they think, who do we go to fix this problem in this marginal field? We have our best people in some large field. Who's the solution company? We want to be the solution company. Okay, so for people that are foreigners coming into the country, a group that they can trust, that manages its operations with the way of doing things of the United States, in terms of integrity, in terms of information, transparency, in terms of telling it like it is. So, okay, coming in, you have a solution company that will help you get established. It will try to solve a situation for you. You can manage your trade union issues, things like that. We want to be in people's minds as, okay, these guys are good guys. For the locals, as Edgardo explained, we want to be the solution to, again, fields they don't have the time to deal with, and they're bleeding profitability from not being well operated. So think of us, GIL-Jagercor Energy is a solutions company for the oil business in Argentina on the conventional side. That's a way to frame us in the beginning. So of course that means we are a service company, and we also have to be very capital efficient. We're not here to throw around money. We don't run an oil dictatorship. We're not Saudi Arabians. We're not Venezuelans. We are people managing our own and especially investors' money. And there's an enormous difference when you don't count your money as yours and you throw it around versus when every penny matters. And so we are starting very small, and so every penny counts, as you can see from the numbers that Eric was mentioning in terms of the money we've raised, our market cap. So we have to be very careful, and we hope to hopefully keep very, very nimble that way. So later on, you could see some interesting acquisitions if they come our way on the conventional side. Something, again, we're going to be looking at cash flow, IRRs, all the measurements that I like to look at as an investor myself. I want things that are profitable, things that are clean, things that are not a shot in the dark. And eventually, you know, we can become some of the success stories that have already started like this. There's a company, Grand Tierra, for example, that started exactly in the same way, like in Argentina with conventional fields. It's now a $2 billion company, very successful. So that's a model for us. And so you could see us in a few years doing acquisitions, hopefully accessing different places in the capital markets, the debt markets, stuff like that, using some of our experience. And you know, at some point, we may decide in a few years to migrate, not just in Argentina, but to migrate to other places in South America with our model. But that's something for much later on than tomorrow and the next couple of years. So that's really how we look at this, and you know, we hope that you think this is an interesting place to start with us. You're really at the ground floor. Our intention is the minute we start producing oil, hopefully we've closed the raise, and my intention is to promote the living hell out of our success when the oil flows out, and so hopefully we have a very nice base for people to start talking about our company, and we can expand that shareholder base as we keep moving forward. So thank you very, very much for spending so much time with us on a Sunday evening.
Thank you, Matias, and Edgardo, thank you as well. So this is Eric Mashinsky with the Gold Investment Letter. If you want to look more into Jagercor Energy Corp, they do trade under the symbol JEM on the Canadian Securities Exchange, the CSE, and also has a U.S. pink sheet component, JAMTF, JAMTF, on the U.S. pink sheets that those of you who are familiar with the Canadian exchanges, I believe it's in Jagercor's future plans to have an official listing in the U.S., but this will flow volume to and from the Canadian Securities Exchange. So I will be following up with my own research report as well as comments that hopefully will complement this webinar to give all of you the information that you need on this interesting early stage play on Argentina oil and gas. Guys, thanks for joining us tonight. We'll talk soon, and have a good evening.
Thank you.
Thank you.